Navigating 2026 with clarity and confidence. I'll be the first to admit I am not a clairvoyant and I certainly don't have the crystal ball. And honestly, I kind of think predicting what the market's going to do in the future is kind of a fruitless task because it's incredibly difficult to identify what we're going to see as returns from one year to the next. It's incredibly difficult. Even the best in the business can't do it. But what we can do is we can look out in the future and we can make some idea and some educated guess on what direction we're headed. Now, we might be directionally correct, but it depends on what degree that we are and whether the market's going to return 23% or be down for the year. It's hard to predict. And if I could predict the markets or the weather in Colorado during this winter, I certainly wouldn't be sitting in this chair. I'd probably be sitting on a helicopter pad in the British Columbia mountains and doing that. But with that, I'm going to dive into some of the aspects that I believe are going to be on the agenda or at least on the horizon for 2026. And if we can't predict, but we can prepare, then I'm going to give you some tools to be able to prepare for what to potentially expect in 2026. Now, it isn't about guessing it right. It isn't about getting the number exactly correct. It's about staying intentional. It's about being informed and being resilient no matter what the market throws at us. So we can learn from what happened in 2025, where we saw a massive drop in the markets during I would call it the tariff tantrums. And that rebounded to end the year on the S&P 500 up about 17%. But we got there in a very zigzagged way. So with that being said, let's dive into what we're looking at for 2026. Some market themes to watch. So first off, I think that we're going to have some pretty strong, resilient growth, but potentially at a slower pace from an economic standpoint. The global economy is expected to grow, and some of that is also going to be driven by strong U.S. fundamentals. And something I saw recently that the Atlanta Fed has adjusted some of their growth targets for 2020 at the end of 2025 going into 2026. And one of the things that they're predicting is potential growth in the 5% to potentially 6% range. Now, that's huge. And what we do see is that with economic conditions, we tend to see momentum being our friend, where, if we start to see strong growth, then we'll continue to see that strong growth unless we see something otherwise. But even with those macroeconomic indicators being strong, so unemployment seems to be steady. We see inflation, if not dropping, under control. We're not seeing big spikes, which is obviously very good. But I think it's more important to be disciplined as it relates to the numbers that we get in our economy. And so I believe that we're going to continue to see pretty decent growth, or at least resilient growth, even in the face of all of the crazy stuff that we continue to see. And so from that standpoint, it's not really worth adjusting a portfolio directly in line with what the economy is doing, because those two things, while they're connected, they're related, they're not a one-for-one correlation to be connected to. So it's certainly something that we need to be aware of, but not something that should always drive every financial decision or at least investment decision. Another thing that is, I think, a theme to watch is this AI hype. And I think that that's something that we've seen over the last several months and really the last several years is this, the massive spend that we've seen from some of these AI companies, whether that's OpenAI, Microsoft, NVIDIA, and some of the circular deal flows that we've seen. And some people point to that as being a sign of a potential bubble. And we seem to be, I think, early in this major expansion. Now, if we look at, the historical moves of innovation, we have a tendency to overinvest, and then there's a contraction. So I'll kind of point to maybe the dot-com era. gosh, we're still on the internet. We're still, even I would even say the internet has grown significantly since the late 90s. But we saw a period where if it had a .com on it, it was worth a lot of money. And right now we're sort of seeing something similar with if it has an AI orientation, it's getting a lot higher valuations. And I think that AI is a transformative force. And I think that it's something that is going to be a major theme of our lifetimes going forward, and something that we should not throw to the side. And I compare this a little bit with the hype of the metaverse a few years ago, where we saw companies like Meta go all in on the metaverse, spend billions of dollars of building out this universe that was online, and it was in this other world that was unfamiliar to most of us, or then NFTs, or some of the craze around some of these things that were going to be the next big thing, and they've really petered out to be nothing. I think that we are in a super cycle for AI, and that's just my personal belief. But I think the market is telling us right now is that it's becoming a little bit more selective, which I think is a good thing. I think it's healthy. And even since the end of 2025, we've seen a little bit of a cooling effect to some of those AI names. And I think that that's just natural. It's sort of about time that we kind of take a break from, these ridiculous returns that are just, every time they release numbers, we see double-digit growth, triple-digit growth in some cases. And I think that right now we're going to be in this proving phase. So companies need to prove that their AI investments are actually driving real world productivity. If there was an inflection point in 2025 for AI, it was that all of these companies wanted to talk about it, they wanted to implement it, but the adoption rates were really low, or at least it wasn't as good as they had hoped. And so I think that that's going to be something that we see going forward, is how do companies adopt AI in a way that's meaningful for productivity, and how does that work, both from a growth standpoint for a company, but also from an economic standpoint. Is there going to be job displacement? Are there going to be some challenges to that? And I think that there is going to be a whole universe of jobs that we've never even thought of that are going to be created out of this hyper cycle of and really a mega cycle of AI. So I think going forward, there's going to be I think the winners will look different from what they look like today. Potentially, I think that some of the names that are that aren't as profitable or that are overspending will kind of take a little bit of a back seat. But I do think that some of those leading names will continue to lead. But at the same time, it's still something that we need to be considerate of, and it's certainly a theme to watch going into the new year. Another area that we are focused on, or at least keeping an eye on, is tariffs and really policy risk. And already we're seeing this across the globe. I think with even just we're only a couple weeks into the new year, and we're already seeing, tariff conversations being brought up. And this is obviously going to be in light of the conversation around Greenland and potentially introducing new tariffs on some European nations. So there's a lot of factors that are at play right now, and we're going to see kind of if the rubber meets the road for some of the tariffs that were talked about in 2025. So I think that renewed tariff conversation, some of that shifting trade policy, and how we're reshoring some of our manufacturing here in the United States certainly will have an impact. I think that does lead to some level of political risk and some economic policies that are dividing, and sometimes how that might upset some economic growth and some factors there, which inevitably will trickle down to some of these companies, some of the company earnings, especially those that have international exposure. I do think that there is a absolute case for having more international exposure, or having more international exposure than we've had in the past here at 4 Points Wealth, because I think that some of those countries, just like the U.S. is becoming more U.S. focused, some of these countries are also looking at being more European focused, for example, making sure that, they're taking care of their trade policies. So it's not just a one-sided thing that the US is just the big bad dog in the street. It's that all of these countries are taking another look at their economic policies and ensuring that they're doing the right thing for their own country, which invariably is going to have a positive impact to those companies that are domiciled in those various areas. So that's certainly something that we're looking at on our end. And then again, I think when we look at some of these economic developments, some of these policy risks, I think they absolutely are going to create some short-term pressure. And again, we've already seen that here to start the year with the conversations around Greenland. And it's kind of a wild thing to think of a country that has 50,000 people having this outsized impact on day-to-day volatility, and certainly probably will lead to some uneven performance across different sectors, across different companies, and things like that. So those are going to be the themes that we are focused on, or at least looking at kind of our top 3 for 2026. Now, areas of growth focus that are on my horizon, or at least on my agenda, is going to be that technology and infrastructure. This is going to be another area that continues to be, I think, a proliferation within our economy.